Insurance professionals work hard every day to keep people safe. But as technology transforms the industry, how can insurers protect not only their clients, but also shield themselves from ever-changing cyber risks? My name's Elizabeth Blossfield, and I'm the host of the Insuring Cyber Podcast, a bi-monthly look into how the world of cyber and the business of insurance are connected. According to Delinea's 2023 State of Cyber Insurance Report, a significant gap is emerging between insurance carriers and organizations who are seeking affordable, comprehensive cyber coverage. Delinea is a privileged access management provider. The new report, based on a survey of more than 300 U.S. organizations, found that the time and effort it takes insurers to obtain cyber insurance is increasing significantly, with the number of companies requiring 6 months or more, and that number growing each year. The survey was conducted by Censuswide on behalf of Delinea and explored trends uncovered in a similar report last year about growing demand for cyber insurance. The cyber insurance protection gap is a big conversation in the industry as premiums have been rising and exclusions and policies growing on the back of ransomware threats, an ever-changing landscape, and a lack of consistent, reliable data to assess risk. Guests on this episode say insurers are facing challenges navigating all of this, and as a result, insurers are struggling to find the right coverage. My first guest for this episode is Joe Carson, Chief Security Scientist and Advisory Chief Information Security Officer at Delinea. He's a cybersecurity professional with more than 25 years of experience in enterprise security and infrastructure. He's also an active member of the cybersecurity community and a certified information systems security professional. Joe is a cybersecurity advisor to governments, critical infrastructure organizations, and financial and transportation industries. He spoke with me about the cyber insurance protection gap and what he sees as some potential solutions, including public-private collaboration, partnership between insureds and their insurers, and more flexibility regarding cyber coverage. He even sees potential for flexible insurance models in cyber that adjust coverage in real time based on changing client needs. He also spoke with me about the findings in Delinea's latest report. Check out our conversation. Hi, Joe. It's great to be speaking with you today. How are you doing?
I'm doing fantastic. Thank you. I'm looking forward to today's discussion.
Yeah, me too. Thanks for taking the time to do this. And I was wondering, before we get into the discussion, could you just start off with a brief overview of your background and some of the work you do at Delinea?
Absolutely. So my background, I've been in the security industry for over 20 years and in IT for over 30 years. So quite a long time in the industry. My primary role at Delinea is doing security research. So I'm the chief security scientist. So I do a lot of security research, understanding different attack techniques, what makes attackers successful, what makes it more difficult. In addition to that, I also do advisory CISO. So I advise a number of CISOs around the world. And Delinea is a company that helps organizations protect privileged access to their organization's assets and resources and infrastructure and critical databases.
Oh, that's great. Well, I know you have great background in cyber, so I'm really glad to be talking to you today. I came up with the idea for this topic because I came across a Delinea report this year that was discussing the cyber insurance gap. And I know that the report found a significant gap is emerging between carriers and companies that are seeking coverage. So I was wondering if you could just give a sort of big picture overview of what's going on and some of the changes from a year ago when Delinea first released this report.
Absolutely. So this is the second report we've done on the same topic. So we did one research at the end of last year, and we decided it was interesting. So we decided to repeat it again this year just to get a comparison. One of the big differences we've found over the past year is the insurance industry is maturing a lot. They're starting to better understand risk when it comes to cybersecurity. They're getting a lot more data that allows them to quantify the risk much more clearly. So we find that the insurance industry is maturing, and as part of that maturity, they're starting to realize that to defend and reduce the risk against cyber attacks needs a lot more, let's say, focus and priority into best practices and enforcing those best practices. So the industry is maturing, and as a result of that as well is that they realize that the cost of security incidents needs to also be covered higher. So therefore, premiums have also increased. With that, it also means that organizations who are down the path of getting cyber insurance have to spend a lot more time, a lot more resources, and put a lot more security controls in place to be considered for cyber insurance. So It's a massive change in how it used to be done previously. It also means that fewer carriers are still making cyber insurance available, and they're being a lot more selective into who they insure as well.
Yeah, a lot has been changing in the industry. So that's a good overview of what's sort of going on. And I was curious what you see as some potential solutions to the cyber insurance protection gap that, insurers can continue to work to protect themselves, as well as protecting their customers.
Absolutely. Some of the things that organizations have found the best practices that really do work is around making sure that you have a strong access control and access security. And that means that when you're implementing solutions like multi-factor authentication, can significantly reduce the impact or reduce the possibility of becoming a victim of cybercrime. So insurers are really looking at multi-factor authentication as a primary security control that all organizations must implement and implement everywhere. So that's an area. Also, organizations are realizing that also some of the best practices insurers are requiring as well is to make sure they're protecting privileged access. A lot of the cyber attacks target privileged access and privileged accounts because it allows the attackers to be successful. It allows them to deploy, nasty malware such as ransomware that can bring an organization to a full stop. So we're also seeing the requirement for privileged access management to be enforced as well, and to be protecting privileged accounts and privileged access, not only just for employees, but also for third parties and contractors and external resources, especially today, as many employees, many the workforce are working remotely. They're working with cloud environments. And this is something that organizations and insurers are really looking to protect. And the other thing as well is having a very, very strong backup and recovery strategy that is really tailored towards ransomware resilient. A lot of the incidents in the past number of years that's been, especially those that have been victim of ransomware, they have backups in place, but those backups were never designed to be ransomware resilient. And a lot of the incidents, those backups were also encrypted and infected with ransomware. So we're seeing that insurers are also demanding that organizations make sure that they have a ransomware resilient backup strategy. And this reduces the need or even the consideration to even consider paying the ransom if you do have a backup that you can go to that is actually available and that can bring the organizations back to operations. Those are some of the best practice controls that we're seeing that insurers are enforcing. The challenge, though, is that a lot of those best practices are part of different frameworks. They're part of PCI compliance. They're part of SOC compliance, the NIST cybersecurity framework, ISO standards. So we're seeing them, and insurers are following those best practices, but unfortunately, they're all choosing different types of compliance and regulations to map to and align to. And that makes it a very challenge because if you decide to change insurance, you have to go through the process all over again. And that risk assessment is not typically transferable because different insurers require different types of best practices and policies, and it's not as consistent as it should be. So that does make a challenge, especially if you're looking to get multiple policies or go down the path of changing insurer. But hopefully in the future, as we get more aligned, insurer does get more mature, that mapping will become more consistent.
Yeah, that makes sense. That is a big challenge. And I know we've spoken for a while in insurance about more consistency within cyber insurance across the board. So hopefully that will change and it'll be interesting to see how things evolve. I know that's a great framework for all of the ways that companies can be thinking about their managing their cyber risk and what insurers are sort of looking for when granting coverage. And then, on the insurance side, I have heard, as the cyber landscape continues to change that some experts believe insurers alone won't be able to narrow the cyber protection gap because of how fast things are changing and because of these regulatory hurdles that you just mentioned. So what are your thoughts on that? And do you expect to see more public-private collaboration on cyber in the future to sort of help narrow this gap?
Absolutely. I do see that it becoming much more standardized, and I do hope that there will be a collaboration between insurers that will provide some consistency. So having a consensus agreement on which framework to follow, which is the one that is the best for organizations and insurers. So I do hope that that's something that will bring a lot together. Also, I do hope that it's something that is a baseline as well. When we look at cyber insurance, it is that financial safety net for organizations to recover, and that's what we should be looking at. Some organizations did consider it as an alternative to security, which is not what it is. And that's something that should be kind of clear and definitely for organizations to consider it. But definitely between private and public organizations, there should be some consistency. There should be a best practice framework that we can actually look to in order to make sure that we're putting the right controls in, and that we are actually making it more difficult for criminals to be successful. So I do believe that this is something that should be a top priority. Just like when you can't get on the road without car insurance. So should you be able to operate a digital business without having cyber insurance? Because ultimately, at the end, you want to protect the service that customers are buying into, and if that service just disappears overnight, it can be devastating for organizations and the economy and people and jobs. So definitely, when it gets into a business that is very dependent on digital services, that there should be some type of at least financial coverage when things go wrong.
Yeah, that makes a lot of sense. And as you said, anything that makes it more difficult for the cyber criminals is definitely important and top of mind. So that's a great point. And I know you touched on this a little bit at the beginning of our conversation, but the report also found that there's an increasing list of exclusions in cyber right now. And I know that there's a lot more awareness about how to tackle cyber risks than there has been in the past, at least among insurers and insureds. Do you see this increase in knowledge and awareness sort of leading insurers to be more comfortable covering these risks in the future? Or, do you expect that exclusions within cyber insurance will continue to grow?
Yeah, that's a great question, and definitely, I mean, when we look outside of cyber, exclusions have always been part of policies. Even if you look at, just simple, car insurance and driving. If you speed, if you don't have a seatbelt on, if you drive recklessly, there is a lot of exclusions in those policies for driving carelessly. I've worked in the maritime industry when it comes to security as well, and I've seen tons of exclusions for vessels, for cargo ships, if they decide to go into, let's say, dangerous waters, if they decide to, go into a storm, if they're, a target of terrorism. There's a lot of exclusions in a lot of those policies. So in cyber, it's not unusual to have those carry over, and they have carried over. But the problem is in cyber is that almost all incidents, you can have attribution. You can always find some dotted line back into a nation state actor. It's so a lot of these incidents are cyber mercenaries who operate independently as cyber criminals, and also sometimes operate under the influence of nation states' direction. So in many cases, a lot of these cyber crime groups, you can have some association to a nation state, which means a lot of the exclusions that we're seeing, things like active war, active terrorism, can be attributed. You can always find something there. So it's really important. I think one of the big cases this year, which is around the Merck case, really set a kind of a direction that's in cyber. That when you go back to the NotPetya case back in 2016, Merck were a victim of that ransomware, and ultimately had several policies and several claims in place. That several insurers decided, this was an act of war, therefore the exclusion applied. And ultimately, the Supreme Court had, resulted in favor of Merck, and that they were not a legitimate target of an act of war. So therefore, that exclusion didn't apply. So this is kind of where we're seeing those exclusions, starting to be more clear and the clarity play out as more incidents and claims are kind of filed. But a lot of exclusions are quite concerning, into things like, where an employee might do a misconfiguration mistake. So an exclusion might be applied for human error. You might find, ransomware exclusions that the policy will cover you for other types of cyber attacks, but ransomware gets excluded. So we're starting to see a lot more finer policies, and therefore organizations will have to start selecting more clearly about which types of policies they want to have in place to make sure their organization is protected. And also, even when we get into not just about the exclusions, but also the fine print. And the fine print is really where some of the terminology that we typically talk about in IT and security, things like backup and recovery. In the insurance industry, sometimes that can mean something very different. Backup and recovery could also mean paying the ransom. So sometimes even the understanding and terminology between both organizations and insurers can be also interpreted differently. So it's really important to make sure that we have consistent terminology across both, so that when we're talking about certain things, we have the same understanding. So that's an important area. But I think definitely it's the maturity of this industry that's starting to see that the more policies growing and more clarity into what organizations really need to have in order to protect the business. So not all policies are equal, and that's an important thing that organizations should make sure that they are getting the policy that's right for the business and right for the risk that they're exposed to. And insurers definitely should make sure that the organizations who are getting insurance are well educated and well understood into exactly what those policies cover. Some things I've seen as well as that in some claims, for example, if you notify the Data Protection Authority and you get instant response, because timing is so critical when you're a victim of an incident, you have to respond very quickly. And some of the policies will, if you don't contact the insurance company first, any costs that you incur before that may not be covered as well. And then, attribution and root cause of attacks are sometimes quite difficult to do. Digital forensics and instant response and root cause analysis can be quite time consuming and take quite a long time, which also does mean that some of these claims could take sometimes, months, but some of them can even take years to be able to be, properly vetted and eventually the payouts. So it could be quite some time for organizations. So we definitely need to make sure that the expectations and understanding is there much better at the beginning.
Yeah, that's so important. And that sort of starts to answer my next question as well, because I know that you mentioned in your comments about the report that most organizations aren't necessarily approaching cyber insurance with the same diligence as insurers. They're simply looking to get covered. So they maybe aren't checking whether the policy they had last year is what they need now, or if anything changed at renewal. So do you have anything else to add about, why that's important, especially in such a fast changing environment like cyber, and, any other advice for insurers about how to make sure they're getting the coverage that they need?
Absolutely. I mean, that's a great point. Definitely for me, it's making sure that since the threat landscape changes and businesses are also evolving with digital transformations and cloud and third parties and service providers and remote workforce, it's really important to make sure that you're adopting your policies to meet your needs going forward. So don't just it's not like traditional home or car insurance or property insurance where the risk is always always kind of predictable. It's always consistent. Where cyber, the threat changes so quickly, it can be different from month to month almost. New technologies, new vulnerabilities, new techniques. So it's really important for organizations to make sure that they're up to date with the types of risks that their businesses are exposed to. And as those change, that they make sure that they mature the policies to adapt to those risks. I think even in the industry, we should be starting to seeing something like a real-time insurance model where, based on the business, decisions, and the risk of the business, that the insurance policy will adopt quickly to meet the needs going forward. So almost getting to something like, the real-time decision making and real-time risks would be a great way, especially when it comes down to, so at least organizations can see, if I make this decision versus this one, how it will impact my coverage. We had this discussion years ago in the maritime where if a captain decides there's a storm and they decide to go around the storm or go through the storm, how does it impact real-time insurance? And does it mean that this taking the safe decision does mean that their premiums and risk will be lower, but yes, they might get some penalties for delay. And be able to value that immediately can make a massive difference in the decision making. And I think this should also be the same for cyber risk. If you decide to deploy or use a certain technology from a business side, that those risks should be clear and known. So I really hope that going forward is that this much more mature and more flexible and more broader types of policies will allow organizations to be able to have that a la carte, kind of choose the ones that meets business and things that they might have already internal capabilities. They might already have retainers for instant response. They might already have a cyber captive that allows them to have some cash to go to in the, when they need that quick access. So having that ability to tailor policies and tailor insurance to the business needs because it's not going to be the same for all businesses. They are all different. They all have different needs and different risks. And cyber and policies should be able to be flexible enough to meet those. So it's definitely, it's very different from those traditional types where everything's kind of, very predictable, going back into having years of data and to be able to make very clear quantifiable risk decisions. Cyber is not that. It's very, very different. It can change from day to day, which is always, which needs to be reflected in the policies.
Right. Yeah. It's difficult to have access to that consistent data when things are constantly changing. But that real time insurance model for cyber is really interesting. That's something I've heard more and more talk about in the industry. So I think you're right. It'll be interesting to see how the industry matures and whether we'll see more flexible policies like that popping up. And, you've given a lot of great points for insureds to think about in managing their cyber risk, as well as, insurers for thinking about the cyber insurance protection gap. So this has been a really interesting conversation. And thank you so much for taking the time.
No problem at all. It's been a pleasure, and hopefully, we'll definitely educate the listeners into some of the vital decisions they might have to make as they go down this journey. Because definitely cybersecurity best practices and insurance are very complementary to each other, and it's important to make sure you have the best coverage for the business, so that when bad things do happen, you can continue, and that's what's important.
Yeah, absolutely. That's a great point. That collaboration between insureds and their insurers is so important. Well, thank you so much for your time.
And thank you for having me on today.
It was great to speak with Joe, and I learned so much from him. By the way, he also hosts a podcast on Delinea's website called 401 Access Denied, and he's an ethical hacker, which we didn't have time to get into on this episode. But he has great background in cyber, so I was glad to speak with him. My next guest dove deeper into the cyber insurance protection gap and its impact on economic security, the subject of his doctoral research. Tom Johansmeyer is global head of index products at risk strategy and reinsurance broker Inver Re and is based in Bermuda. He's also a PhD candidate at the University of Kent, Canterbury, and previously served as the head of PCS at data analytics firm Verisk. Under Tom's leadership, PCS developed the first tools for global cyber risk. He previously held insurance industry roles at Guy Carpenter and Deloitte, and he also previously served in the U.S. Army. He spoke with me about blending the cybersecurity discussion into prevention and remediation, as well as eliminating some of the alarmism in cyber, especially when it comes to large-scale catastrophes. He presented an interesting perspective for insurers to think about. Here's what he had to say. Hi, Tom. It's great to be speaking with you today. How are you doing?
Doing well, Elizabeth. Thank you. Likewise, great to speak with you.
Yeah, thanks for taking the time. I'm really looking forward to our conversation. I know we're talking about the cyber insurance protection gap. But before we get to that, I was wondering if you could start off with just a brief overview of your background and some of the work that you do.
Excellent. Be happy to. So I'm currently the global head of index classes at reinsurance broker Inver Re. This puts me in the world mostly of industry loss warranties, ILWs. That includes both Nat, Cat, and MAID, all reporting agent and data providers, and kind of Nat, Cat, and specialty, right? So obviously, having come from PCS, I'm very comfortable with US, Canadian, and Mexican natural catastrophe. And then I developed the entire specialty lines loss index platform while I was there to include cyber. So basically, my background is having come from the industry loss reporting world, I'm now in the space of kind of structuring and placing those ILWs and bringing a unique perspective on the underlying data and the risk environment. Further back in my career, I was a tech guy in management consulting to include Deloitte. I was a Guy Carpenter for a bit, and I started it all out in the U.S. Army in Korea, 1997, 1998.
Oh, wow, that's great. Well, thank you for your service. And, it sounds like you have such a great career and great, background to be talking about, what we're talking about today. So I'm glad that you're here. And I know last time we spoke, you mentioned that you were working on a doctoral dissertation right now about the cyber insurance protection gap as a state level economic security problem. So I was curious if you could talk a little bit about what you're seeing there and some of the focus of your research.
Absolutely. So I'm working on my PhD at the University of Kent, Canterbury in the UK. And it's the world I'm looking at, the degree is in international conflict analysis, not risk management or insurance or economics. And specifically, when you start with the threat that cyber poses, it's largely an economic security threat. Yeah, if you like the odd movie, of course, you'll look at the scenarios where somebody quote unquote hacks the nukes or takes down the grid or does some other like post-apocalyptic fever dream type stuff, and then chaos ensues, right? That's not really the world we live in. When you look at most of this, I know, right? When you,
Surprising, yeah.
I mean, people lose sight of the fact that, this stuff has never happened. And you often hear people say it hasn't happened yet, but I'd like to, see a little evidence for the yet, right? What you look at in the cyber domain is more overwhelmingly economic security issues, economic implications, to the point where when you talk about cyber impact, there are really two metrics you hear, either nodes affected, right? Like servers taken out, phones taken out, or economic loss. So if you look at the impact of NotPetya, for example, in 2017, folks will talk about the thousands of computers that were wiped, or they'll talk about the Homeland Security Department's $10 billion economic loss estimate. Or third, they may talk about the $3 billion insured loss estimate that PCS produced when I was there, which I'll now caveat as reminding people 90% of that was property, not affirmative cyber. So cyber is by and large an economic security problem, which means we need to think a little bit differently about how we approach it. So instead of prevention at all costs, we need to blend the security discussion into both prevention and remediation. Now, when you think about cyber, right, money helps fix things. When you are attacked, you need to restore systems, you need to patch, you need to find the vulnerabilities, and you need to get people back in good working order. Also, you've got some crisis comms and so forth, all of which is fueled by capital. So in the economic security context for cyber, what would be really useful is a mechanism by which capital is deployed after an event according to pre-agreed terms and can be generally expected to arrive as and when necessary. And that is literally what insurance is. So insurance becomes an important lever in the nexus of economic security and cybersecurity, which means we should think more and more about how we bring capital to bear on a contingent basis for issues related to cyber threats and cyber attacks.
Yeah, that makes a lot of sense. And you raise some good points. I mean, obviously, some of the movies we see probably aren't great resources for modeling cyber risk, but I think what you said makes sense. And that kind of leads into my next question as well, because I know that you wrote in an article for Lawfare about the ILS market in cyber, that you see plenty of room for growth there. And you mentioned that cyber is a diversifying risk for ILS managers, which could make it a more attractive class of business. So I was wondering if you could talk about what you're seeing there and why you think the ILS sector could offer additional support to the cyber insurance market.
The ILS market doesn't get enough credit for the work it's already done. Through my research, I've found at least 10 ILS managers who have participated in cyber risks already. Some of them are big and high profile. Others have done so very quietly. Some do it as part of larger relationships. But the notion that we're now in double digits, that's meaningful. And when you talk to most people, they'll cite, ILS participation in the Beasley trade or the Munich Re retro, all of which is headline and important. But there are enough smaller trades going on out there that the foundation for future deployment is growing. Now, the question isn't how do we get more small gains? I think there's enough momentum to make that happen. It's how do we do this transformationally and scale it? And that's where I think the fundamental issue is diversification and correlation. Now, what's nice is cyber does provide an opportunity to diversify for ILS managers, particularly given not just how massive property cat is in that world, but also within that, US and then like Florida or Gulf, right? You've got just so much of the cat market is wrapped up in so few peak perils and regions that diversification within that context is hard to achieve. Now, when you think about diversifying away from those existing risks and building a more balanced portfolio, the other question is, what risk is then also not correlated with financial markets, right? Because the purpose of the ILS market isn't just to find diversification, within the context of a nat cat mainstay. It's also to find other opportunities that aren't correlated with financial markets. That's the purpose the ILS market serves for end investors. And this is a topic of considerable debate with regard to whether or not cyber is correlated with financial markets. I guess on the one hand, you've got no evidence of any serious correlation. And in fact, there are only few instances where a cyber attack on a single company has moved that company's share price. So it's limited on that targeted basis. On a mass basis, we've not seen anything remotely close. On the other hand, when people talk about correlation with financial markets, you hear stuff like, what if they, whoever they are, take down the grid? What if, there is a simultaneous attack on the three major cloud providers that takes them all down? Would that move financial markets? Yes. Is that a world I want to live in? No, because an attack like that is beyond what you would see as a state level attack. It would, to my mind, it would almost require coordination among the world's greatest cyber powers, many of whom are adversaries with each other, right? So basically, you'd need the entire world to align against these three cloud providers, and even that is still not a sure thing. So the types of event where a cyber attack would move financial markets, if they were possible, would be so extreme as to make probably the insurance market unnecessary, right? That takes us into canned goods, clean water, and ammunition territory.
Right. And that's terrifying territory to be in. So hopefully that doesn't happen. But
probably won't. I mean, seriously, that is when you look at what a remote risk is, it's something like 3 or 4 times the size of the NotPetya attack in terms of insured loss, which is itself massive in scale. But also, when you look at economic losses from cyber attacks over the past 25 years, they are declining in frequency and severity. So basically, the upper end of what you need to worry about is coming down. There's this notion that the bad guys are always 2 steps ahead. That's only true when the good guys aren't patching, right? The bad guys aren't doing these massive, 7 0-day vulnerability, complex tools to go out and hack. That's state level stuff, and it's also expensive. So the reality is the good guys are doing a good job. As dependence on the internet has increased, commitment to security has increased profoundly as well. And cyber is reversible, which means when damage is done, it's easy to fix it. So when you think about reversibility, it's best to think about a spectrum, right? And let's talk kind of kinetic warfare and military damage at first to set the scale, right? At one end of the scale, you've got attacks that are highly reversible, small arms, right? Somebody shoots up a building, somebody throws a grenade. The physical damage from that is relatively small and confined geographic scope. At the other end of the reversibility spectrum, you've got nuclear warfare, right? If you can patch up a building that's bullet pockmarked in a day, nuclear, on the other hand, renders a piece of land unusable for decades or centuries. That's not reversible. So where does cyber fit in this? When you look at cyber attacks over the past 20, 25 years, it's a lot closer to small arms than it is to nuclear. Colonial Pipeline was back in 5 days. The Saivach wind farm in Ukraine has been down for, a year, and probably will be for a while.
Yeah, that makes a lot of sense. And it sounds like, we've heard for so many years so much gloom and doom about cyber, it feels like, but it does seem like, the more that we learn, the more insurers as well as, consumers and cybersecurity experts are getting their arms around this risk. So that makes a lot of sense what you said. And kind of keeping along with this conversation on bringing more capital into the market as well. I know that you have a focus on reinsurance, and I've heard a little bit of talk in the industry that instead of approaching all risk cyber with this sort of one size fits all approach, separating cyber reinsurance into three different sectors, first party, third party, and catastrophic losses could help bring more capital into the market. And I was curious what your thoughts are on that perspective and whether you think this one size fits all approach to cyber is contributing to some of the challenges in the industry right now.
The one size approach is definitely a problem, and it's easy to see its roots in risk transfer so far. So the one size fits all is literally the result of over-reliance on quota share risk transfer, right? Quota share means you're ceding to me like a big chunk of everything. So I'm getting your attritional, I'm getting your systemic, I'm getting your first party, I'm getting your third party. I'm literally participating in your underwriting. It's all well and good for the early days when reinsurers want to weigh into the market to learn, but haven't invested in the expertise. Yes, you take some risk, but the risk you're taking can be considered akin to paying tuition to learn. Potentially costly tuition, but it gets the job done. All right. Figure 13-ish billion dollars in cyber insurance premium worldwide right now. Roughly half of that seeded out, so 6.5 billion in cyber reinsurance premium worldwide. 90% of reinsurance is done on a quota share basis, give take. The rest is non-proportional. Okay. That's the landscape. We just set the scene. Now, the overwhelming use of quota share risk transfer means, yes, first party, third party, attritional, systemic, all gets moved from the insurer to the reinsurer, which means if the reinsurer wants to deploy more capital, they either have to allocate more to support the quota share work or manage what they've assumed to optimize capital deployment. What's that mean? Hedging out the volatility, hedging out the systemic, literally what cat reinsurance has been doing for decades, right? So when you look at, property insurance book, they will hedge out hurricane and quake or all nat cat and keep the attritional. And they're not, what's interesting is when you look at the homeowner property, you've got first party and third party in there, right? You've got property, you got liability, you've got cat, you've got non-cat. And the reinsurers are taking the cat portion and hedging it out, sometimes per peril. That absolutely could happen in cyber as well. And to some extent it is. There are some parametric cloud products out there that do that. There are some peril-specific trades, not many. The problem is finding the right buyer for that sort of cover. Now, in the insurance market, there has been more trading being done with both stop loss and excess of loss covers, event covers. And I think that trend will continue, but it'll move slowly. So we're already seeing the cat portion, if you will, start to get hedged out. Now, going down to first party, third party, I think it's a little trickier. It's doable, right? But I don't know that you would see that done outside the context of an event. I could see, for example, seeding out an event cover, like a cat cover, that's first party only, right? Think about like a mass ransomware wiper or cloud event where you're literally taking out the property and BI style covers and not taking on any lives. That to me sounds a lot like hedging out hurricane or EQ in the cat space. So simple answer, yes, is part one. Part two is property cat already figured that out. Part three is look at what property cat is doing and start to find a similar approach.
Okay, yeah, that makes a lot of sense. And, one other thing I was curious about regarding the cyber protection gap is, I've heard some experts saying that insurers alone might not be able to narrow this gap just because of how fast everything changes in cyber and, some of the regulatory hurdles. So there'll need to be more private and public stakeholders collaborating to find solutions. I was just wondering what your thoughts are on that and, whether you expect to see more public-private collaboration on cyber in the future.
So I would say that public and private's important, but not to make a big deal about it. So again, you take a look at property cat, that's already happening. You've got government supports and backstops. You've got risk pools like fair plans and cat pools and JUAs. This is all, there's a model for this already. I think what the cyber sector has to realize is that they're not as unique as they think, and that the analogs to property cat are very clear, very real, and very useful. So, by avoiding those similarities, cyber can stay niche and I guess kind of cool. But profitability is probably cooler, and profitable growth is really cool. So commoditizing a bit would actually enable the hockey stick that everybody's waiting for in the cyberspace. I think that some amount of pool support or government involvement or public-private partnership is a good idea, but I would say do it to the extent that we're seeing it in cat right now. It can be done on a relatively non-invasive basis. And I think the bigger context also is to think about what the protection gap actually means. I think too many folks look at the entirety of cyber exposure, economic first, third party, the whole bit, right? And look at that as the entirety of the protection gap. While that may be true on a technical or a definitional basis, I think practically it is not and never has been, right? Simply because even if there were enough capital to support enough insurance to achieve 100% penetration through the entirety of what is now the protection gap, how much of that would make sense to buy, even if buyers had the resources to do so? Right? Nah, you're going to take some of that on your balance sheet. You look at that in property, it's done that way. You look at it on a personal basis, right? Do I insure myself to the hilt? Do you buy insurance for every single exposure in your life? No. We take some of it net. Everybody has a certain amount of risk that they can afford to assume. And then they have a certain amount of risk they're forced to assume when the hedge is not economical. This sort of thinking needs to be applied to cyber, which basically means, taking the alarmism out of the discussion and thinking more practically. In my doctoral research, I conducted interviews with 30 odd insurers, reinsurers, and ILS managers. And I was stunned by the number of practitioners in this space who told me they believed the US cyber insurance market was somewhere between mature and saturated.
Oh, wow.
Yeah. So, when you think protection gap, I mean, yeah, there's a theoretically vast scope, but on a practical basis, it's much narrower. Now, do I believe that the insurance market has achieved full penetration in the US or worldwide relative to the practically addressable risk? Probably not. And I think some of that's due to market dynamics like pricing, where some sort of self-insurance or keeping it net is just more economically feasible, but not ideal. But I don't, when I hear these, 98, 99% rates of underinsurance, that's just noise, because a good chunk of that is not and never would be insured, just as is the case in any other class of business.
Okay, yeah, that makes sense. That's a helpful perspective. And I think you mentioned something that's so important is taking the alarmism out of the discussion. That's so important in cyber because there's so much alarm, and it makes sense because, the landscape changes so quickly, but it's important to think practically. And I think kind of going along with that, you've given a lot of great things for insurers and, consumers like to think about with this discussion. But what advice would you give to insurers for, staying on top of the changing cyber risk landscape, but, as you said, thinking more practically about it?
Always look for the narrative, right? So when you're building out a realistic disaster scenario, or you're contemplating the sort of situations that could cause disproportionate damage to your book, build the story around it, right? So let's take that example of the 3 major cloud providers all being taken down at the same time. Build the narrative. How does that happen? Who does it? Are they capable of doing it? What's their motivation for it, right? If you can't build the story in a credible manner, then it's not the risk you think. This is actually particularly interesting with cyber war, right? Because we hear a lot about war exclusions, war language, the threat of war to the business. War is not the problem. Cyber war is not the problem, mostly because the academic world has pretty much debunked the threat of cyber warfare on the scale that the insurance industry worries about 20 years ago. They figured out 10, 20 years ago that cyber war as the bloodless alternative, but still massively impactful alternative to kinetic warfare isn't realistic. It's too expensive. Once you take down a target, it, through reversibility, can be rebuilt quickly. Cyber war doesn't work. Even as an element of a combined arms approach to warfare, it's limited. So what's the real problem? Fear. The fear of cyber warfare is keeping capital out of the cyber insurance and reinsurance industry, which itself is perpetuating the addressable insurance gap problem, which itself then feeds the economic security problem. So basically, fear of cyber war is more of a threat to security than cyber war itself. So if we can wrap our heads around that chain, come up with a real fix to the flow of capital relative to issues such as cyber war, we could actually sufficiently capitalize the industry to the point where the insurance protection gap closes and we achieve a considerable amount of economic security and simultaneous insurance industry profitable growth.
Yeah, that's really interesting. That's such an interesting perspective that the fear of cyber war is actually a greater threat, because you're right. We do hear all the time, some of the alarm or the fear about what if a cyber war happens, but we don't often talk about the fact that you're right. It would be extremely expensive, and how realistic actually is it? So I think that's a great point. And, you've given a lot of great advice to insurers and just, great things for the industry to be thinking about. So I really appreciate you taking the time today.
Thank you, Elizabeth. It's been my pleasure.
That's all for this episode. Thanks to Joe and Tom for taking the time to speak with me, and thanks to all of you for listening. Once again, my name's Elizabeth Blossfield, and I'm the host of the Insuring Cyber Podcast, a bi-monthly look into how the world of cyber and the business of insurance are connected. Be sure to check back for new episodes publishing every other Wednesday, wherever you get your podcasts. Talk to you next time.